Hello. The company being analyzed today is Shiv Texchem Limited. This is a fast-growing company which imports hydrocarbons for other companies. So today, we're going to analyze the company's financials, what it actually does, and its future outlook. So let us start. First, we have a market cap of 414 crores, so pretty small cap company. Stock price to earnings ratio 5.88, only that much. Current price of one share 179 rupees. The book value, that is the assets minus liabilities, book value per share 162 rupees. Return on equity ROE is pretty nice, 18.3%, and return on capital employed of 14.5%, which is decently nice. Then let's go to the profit and loss. You got the sales, operating profit, and very much below the net profit of the company from 2021 all the way to 2025. So, in fiscal year 2021, the company reported sales of 334 crores, an operating profit margin of 5%. So, low operating profit margin company. All right. We move all the way to fiscal year 2025, the latest year. Sales of 2,202 crores, 86 crores of operating profit, 4% operating profit margin. And finally, 66 crores of profit before tax and 48 crores of profit after tax. In terms of growth, you can see compounded sales growth has been 37% last 3 years. TTM, trailing 12 months, meaning the previous 12 months, 37%. So, like currently, we are in November. Latest sales for September. So, from this September to back September, last 12 months of sales. TTM. Compounded profit growth has been 59% over the last 3 years. In trailing 12 months, 79% is the profit growth. And return on equity has remained stable at 18%. 3 years ago, 18%. This year, 18%. Okay. Cash flows is not a company's strong suit. Here we have the cash flows from operating activities, focus on that. 2021 minus 81 crores. You go to 2023 minus 162 crores, one positive 58 crores, but now 116 crores negative cash flows in 2025. So it is not a company's strong suit. Now we have covered the financials. Now let's discuss what the company actually does. Shiv Texchem, building scalable supply chains for critical chemicals. Main keyword critical. Okay. So Shiv Texchem Limited imports and distributes hydrocarbon based chemicals, supplying critical raw materials to industries such as paints and coatings, specialty polymers, pharmaceuticals, industrial chemicals, agrochemicals, and printing inks. 45 products, 10 plus industries it is catering to. So it is catering to a wide variety of companies. Okay, 750 customers it has, including some massive names. 0.49 is the debt to equity. Here the results, these numbers are a bit different from what we saw in screener. Okay, 37% revenue CAGR from 2020 to 2025. PAT, profit after tax, 651% CAGR. So main thing, it builds supply chains for critical materials. Okay, critical materials being the keyword. Then, oh sorry, yes, India imports 45 to 50% of its hydrocarbon based chemicals. Okay, and heavy reliance on few players exposes domestic industries to supply risk and price volatility. Then, if we look at the past scale of the company, you can see 2005. 2005, the company had revenue of only 2 crores and number of products. Number of products was how much? This not even given. Number of products is not even given. Hold up, let me just see this. Yes. Now, let's move to 2016. In 2016, it had 104 crores of revenue and four products. And basically, you can see the number of products has risen a lot and revenue has also risen a lot. So let's go in 2022. 858 crores of revenue, 26 products. Then 2024, 1500 crores of revenue, 39 products. So as number of products are increasing, it's adding more and more products, making more and more revenue. Then we move on to this. Is this the one? Yes, this is the one. Okay. So 43 key chemicals are sourced from global suppliers, around 45, 43. 12 of these are raw critical materials. Okay. Critical. These are the critical ones. Then Yes, some of the industries it is catering to, like the printing ink industry, the Indian one, packaging, paints and coatings, you can see the estimations. Like in 2023, agrochemical industry is $33 billion, estimated to grow to $51 billion in 2030. All these figures are to show one thing, that the industries it is catering to, at least they are also growing. Like $300 billion was the, I guess, the Indian petrochemical industry. I think not the Indian, the global petrochemical industry estimated to reach $1 trillion by 2040. So you can see all the industries are large and they're growing. So we want to see that. Then Shiv Texchem's competitive edge. Now, it imports these critical raw materials, but does it do any more of that? Does it provide any more services to that? So we have two things: proprietary, that is developed on its own, value added tools, and second is end to end storage and handling services being provided by Shiv Texchem. Okay, we will discuss this, but before that, we have the balanced revenue contribution across portfolio and customers. All right, so first we have a diversified product mix. The top one product contributes 14.17%. Yes, 14.7% of the revenue in first half of fiscal year 2025. First half means quarter one plus quarter two. So overall, the top one product contributed 10.5%, before that 22%. Then the top five products contributed 47.3% of revenue in first half of fiscal year 2025, and top 10 products contributed 71%. So the top products, there is a bit of concentration. Okay. Then distributional revenue based on customers. The top customer contributed 4% of revenue in first half of fiscal year 2025. Top 5 customers 11%, top 10 customers only 16%. So on the customer side, it seems there's not a lot of concentration risk. Yeah, the top customer does not really contribute the most. Then it's a partner to leading corporates like Jensen, Pidilite, Apotex, Reliance, Bayers, Starinix, Bagla, Tokyo Inc., Glenmark, Berger. So some big names, even ITC. Yes, ITC also. Then we have the edges. Yes. Now we will talk about the value added tools. First is this: a proprietary predictive model guiding data driven pricing and negotiations. They have their own software model where they can predict the base prices of raw materials. Okay, they will predict the base prices of raw materials and give these insights and predictions to their customers, who can then make the choice, who can make the decisions as to when to buy in order to benefit from these predicted future prices. Okay, so proprietary model predicts base chemical prices ahead of the market, and proactive insights are shared with the customers for better decisions. And the benefits: lower cost for customers, forward visibility, and assured supply continuity. All right. Oh, sorry. Yes. So this is the first one. Then another value added service is customer support enhanced by real time tracking. Real time vessel tracking for all shipments, and customers access exact location and the FTA of products. So this transparency is real time tracking of where the product is. Then the last one is end to end storage and handling services. So we have this Deen Dayal Port Kandla and the JNPT terminal. So from what I understand, they don't actually own a port, they don't actually own a terminal. They have leased these places out, rented these places out, from what I remember. Okay. But basically, they have a total storage capacity of 50,000 to 60,000 kiloliters per annum worth of capacity. You can pause and read these three things. You can see what kind of facilities, the storage facility, what features do they have to store what kind of chemicals. Basically, this is another value added service for the company, and handling the storage for these chemicals after importing them, handling the storage for them. Then a brief financials. So EBITDA, profit after tax margin only 2%. Again, we discussed this. EBITDA margin around 4%. You can see the income has risen massively. Return on equity around 14%. Okay, return capital employed 21%. These are the figures. Screener had them a bit different. They have this bit different, but okay, all right. The balance sheet strength, the interest coverage ratio, very important, which is the EBITDA divided by the interest payments. This shows how simply the company can actually pay the interest, how difficult it is, how much of a burden are interest payments for the company. 4 is actually pretty healthy. Less than 1, that's concerning. Net debt to equity ratio, bit on a decline right now, 0.49, increased massively to 1.59 in fiscal year 2023. Here we have the working capital days and cash conversion. Again, we saw cash flows are not a strong suit the company. They have really struggled in cash flows. So here are the receivable days. How long does it take for them to get the money back from the customers after they have provided the service? For 75 in 2022, 51. That's a good thing. That's a good thing. Payable days, how long does, does the company take to pay its suppliers after already being supplied the raw materials? Was 88 days and 84, 51, 64. Okay, okay. I think it's good that receivable days are actually less than payable days, meaning it takes them less time to receive the money from the customers than it does to pay to the suppliers. So that's a good thing. And inventory days, how many days does it take to convert inventory into cash? Lower these days, way better. So 54, 73. Okay, all right. At least receivables have gone down a lot. Okay, that's a good thing. Then where are we? Yes, final. The growth outlook for the future. What is this? Okay, growth outlook for the future. They're estimating the total income to rise from 2,205 crores in fiscal year 2025, reaching 3,100 crores. Let us do the calculation with the calculator. 3,100 crores, 2,205, 40% growth, for 40% growth in revenue in fiscal year 2026. Then 4,200 crores of revenue for fiscal year 2027. So 38% CAGR. EBITDA, they're estimating to grow slightly faster than, what do you say, revenue, reaching 175 crores by fiscal year 27. And they're estimating profit after tax to reach 100 crores in fiscal year 27 from 48 crores. That was it. That was Shiv Texem Limited. Bye.